Hey, Assalamu alaikum. Uh, so, in this class, we'll be doing practice of double A section A questions. And so, let us start with it straight away. So, here it is. Let us start with it. Uh, the following scenario relates to question number one and five. The board of directors of sister company are concerned that they are not currently applying applying best practice in terms of corporate governance, okay, and are seeking to make improvements. Okay, so the company currently has three non-executive directors on the board who are paid a fee which changes annually depending on company performance. The entities all sit on the audit uh, nomination and remuneration committees. There is currently no reference to the work of these committees in the annual report. So at present, sister company does not have an internal audit functions, but the directors are establishing a team which will be responsible for a range of internal audit assignments. The following is the current proposed structure of the internal audit department. So here it is, finance director, then we have head of internal audit manager, audit assistant, and auditor. The only role still to be filled is the head of internal audit. There are two potential candidates, Paul, billing consultant, who helped design and implement the company's current control system, and Maria Marquez, who is currently an audit manager at Rossi and Ball, an audit firm which has never been used by the sister company. Okay. Out of the other three members of the proposed internal audit department, two of them have moved from other departments and sister company, and out of other three members of the proposed internal audit, two of them have moved from other departments in sister company, and none of the audit assistant has audit experience. Okay, so which of the following should be included in the annual report regarding the work of the audit committee? Uh, Responsibility for preparing the annual report and financial statements, significant issues considered relating to the financial statements, and considered relating to the financial statements is our correct answer. We do not even need to look at other options now. So how this is the correct, the annual report should describe the work of the audit committee, include significant issues considered relating to the financial statements, how it has assessed the independence and effectiveness of the external audit process, where there is no internal audit function, and explanation for the absence, uh, and how internal assurance is achieved, an explanation of how auditor independence and objectivity are safeguarded if the external auditor provides non-audit services. So the other options would be included in the annual report, but are not related to the work of audit committee. Option one relates to the directors. Option three relates to the board, and option four relates to the nomination committee. So option two is the correct one. Understand? Next question we have that is saying, which of the following options correctly describes the deficiency relating to non-executive directors' remuneration and makes a valid recommendation for improvement? Deficiency recommendations. So companies, non-executive directors, entities should be remunerated on the same basis as the execution team. Okay. Next, we have compromises the motivation of the NADs. NADs remuneration should be tied to profit targets. No. Then companies Compromise. Compromises non-executive independence, and it is remuneration should be set amount based on time committed. Yes, this is the right option in this regard. Okay, so option three is our correct answer. Why? See, non-executive remuneration should not be tied to the performance of sister company, as this can compromise the independence of the non-executive directors. So, non-executive directors should be based on the time committed to carry out the role. Next, next question. The board is in the final stages of establishing the internal audit department. So we have to select one option from each column, which provides appropriate recommendations to improve the effectiveness and independence of the internal audit department. So they should report to audit committee. Head of internal audit in this case is Maria Merquez, according to the scenario. Okay, we just look at the scenario. Then remaining staff members appoint more senior staff with the audit experience, as we noticed into the scenario that most of the assistants are juniors and they have less or no experience. So to ensure effectiveness of the internal audit function, it should report into the audit committee. Maria Marquez should be appointed head of internal audit, as she has audit experience it, and she is independent of the company. Paul Belling helped design and implement the current control system, which creates a self-review thread. So only one of the remaining internal audit staff members has audit experience. Therefore, more staff should be appointed with audit experience. Okay. Next question. The board has started to compile a list of tasks for the internal audit department to carry out once it is up and running. It has been agreed that the first assignment to be completed will be for internal audit to review sister companies' process over asset expenditure to verify if the right items are purchased at an appropriate and competitive price. So, what type of internal audit assignments does this represent? A value for money audit, a management audit, a financial audit, and internal, IT audit. Well, in this regard, the answer is value for money audit. Why so? Because the assignment described represents a value for money audit, as it is focused on assessing the economic efficiency and effectiveness of sister companies' asset expenditure. So option one is absolutely correct. So the last question of option five, the first scenario, that is question five. Uh, when deciding, when deciding on the role of the internal audit department in understanding operational audits, which two of the following should the team not be involved in? Observing procedures carried out by sister companies staff, reperforming procedures documented in procedures manuals, designing and implementing designing and implementing internal control procedures to address deficiencies. Yes, this one is the right. And reporting findings directly to the board of directors. No. Authorizing transactions and performing reconciliations. Yes, this is the right option. Why? Now, let me explain you. Authorization of transactions and performing reconciliations are the type of controls procedures. Internal audit should not design and implement internal control procedures as this will create self-review threat. When they subsequently test the effectiveness of the controls implemented, internal audit should report any deficiencies identified and provide recommendations for improvement. Management is responsible for implementing the recommendations. So far, so good. I hope it is clear to you guys. Now, the new scenario we are starting. Okay. That is now the following scenario relates to the questions. That is question number 6 to 10. Okay, you are an audit manager in Bark and Co. and have been assigned to the audit of Foliage Co. for the first time in this year. Okay, this year. Foliage Co. is a listed company which specializes in manufacturing musical instruments. You will be taking over from Kim Baum, the audit manager who has been in charge of the audit for the last 3 years. Kim has just announced that he is leaving Bark and Company to join Foliage. Okay, Co as the financial controller. Kim has recently completed the planning for the current year audit in preparation for the final audit, which is due to commence next month. Okay. JN Leaf has been the audit engagement partner since Foliage Company became an audit client almost 8 years ago. Oh, ho, ho, ho. As she has completed 7 years as an audit engagement partner, JN Leaf believes that in order to maintain a close relationship with Foliage Co, JN Leaf should undertake the role of engagement quality reviewer this year. Okay. The total fees received by Bark and Co from Foliage Company in respect of the services provided in the last year announced to 16% of the firm's total fee income. The current year's total fee income for the audit tax and audit related services is expected to be greater than last year. So now question number 6. What is the most appropriate response to the suggestion that Jane Leaf takes on the role of engagement quality control reviewer? Well, uh, just a second. So, yeah, Jane Leaf could take the review role immediately. No. Jane Leaf could take the review role immediately, but additional safeguards will be required. No, Jane Leaf should not serve as the engagement quality reviewer for a period of at least 5 years now. As Foliage Co. is a listed company, Jane Leaf should not serve as the engagement quality reviewer until a cooling off period of 5 years has passed. Remember that. Let me write it for you as well. As Foliage Co. is listed company, okay, Jane Leaf should not serve as engagement quality reviewer until cooling off period of 5 years. Okay. Next question. Which of the following is the least appropriate response in relation to fee income received by Bark and Co. from Foliage Co? Bark and Co. should assess whether audit and non-audit fees would represent more than 50 consecutive years. Okay. No. If the recurring fees are likely to exceed 15% of annual practice income this year, Bar will need to resign as auditor of Foliage Co. And yes, this is the right answer, as Bar and Co. should assess whether audit and non-audit fee would represent more than 15% of gross practice income for 2 consecutive years. Okay. If the recurring fees are likely to exceed 15% of annual practice income this year, additional consideration should be given as to whether the taxation and audit related services should be undertaken by the firm. This is particularly important as the client is listed and many additional services are prohibited. So, in addition, if the fees do not exceed 15%, then this should be disclosed to those charged with governance at foliage. Resigning as auditor would only be required if all the other options do not reduce the threat to an acceptable level. So, yes, this is the answer, option two. Okay. Next question. What action should Kim Bom have taken when the possibility of employment with Foliage Co. arose? Kim should have notified Bark and Co. of the potential employment so he could be removed from the audit team. Yes, this is the right answer. Okay, as you know, not a why so, because the ACCA Code of Ethics and Governance requires individuals to notify the firm of the possibility of employment with an audit client so they can be removed from the audit team. Next question. What is the next question now? Which of the ethical threat will be created when Kim Bomb commences employment with the client, and what action should be taken to manage the threat? Well, there will be intimidation threat. The manager should be allowed to take the role of the financial controller. No, this is not the answer. Okay. Familiarity threat. The composition of the audit team must be reviewed and changed as appropriate. This is the right answer. There will be a familiarity threat because of Kim Bomb's relationship with the audit team. The audit team may be too trusting of their ex-colleague. A self-review threat would be created if an employee of the client joined the audit firm and was assigned to the audit of their previous employer. A self-interest threat would have arisen during the recruitment process as the judgment of the audit manager may have been affected by the desire to be appointed as a financial controller. Now, the next question and the last question of the scenario, and the which is the what is the last question? They're saying select whether the following statement described a rule book approach or a conceptual framework approach to ethics. Okay. Clearly defined laws for the audit to follow. Well, it is a rule book approach, uh, useful in dynamic environment. Well, it is a conceptual framework approach. Then a set of guidelines with which the auditor uses judgment to apply to specific circumstances. We have it is also a conceptual framework approach. Okay. Easy to know what is allowed and not allowed. It is a rule book approach. So far, so good. And we are done with the first 10 questions till now. Then we have, so remember, in this case that the conceptual framework provides guidelines with the objectives that the auditor chooses the most appropriate course of action in the circumstances. This allows flexibility to deal with all possible situations, which is useful in dynamic environment. The guidelines followed are professional guidance but are not law. Laws clearly outline what is acceptable and not acceptable in specific circumstances. Uh, we have another scenario. The following scenario relates to question 11 to 15. Okay, and so in this regard, now let us look at the scenario first. You are an audit manager in Miranda and Company, and you are planning the audit of Milbury Company, which manufactures luxury handbags and other fashion accessories. Milbury Company has been an audit client of your firm for 4 years. Okay. From a review of the correspondence file, you note that audit engagement partner and the finance director have known each other socially for many years. That means familiarity threat here. What is their familiarity threat? And in fact, went on study buddies. Okay. So as a result of this friendship, the partner has not yet spoken to the client about the fee for last year's audit. Overdue fee threat, 20% of which is still outstanding. The financial controller of the Milbury company was appointed 2 months ago. Prior to this appointment, the financial controller was an audit senior at Mirinda and Co. and was a member of the audit team for Milbury Company. Employee of Milbury Company are entitled to purchase handbags at a discount of 40%, and during the planning meeting with the finance director, you and your audit team are offered the same level of staff discount. The finance director has asked if your firm will prepare the company's tax return and provide tax advice to minimize the amount of tax payable. Okay. So many threats everywhere, everywhere, here, there, everywhere. We are getting the threats. Now let us look at the requirements. Uh, Select which threat to objectivity is created by the information obtained from the review of the correspondence file. Okay. Uh, the partner and the finance director have known each other socially for many years. What is it? What is it? What is it? Yes, it is familiarity threat. Okay. Uh, 40% of the fee for the last year audit is still outstanding. Its advocacy, familiarity, or self-interest. It is a self-interest. It can give rise to a self-interest threat. Cool. Done. Next question. Social risk relationship give rise to a familiarity threat. Outstanding fees can create self-interest and intimidation threat. Option. Okay. Now the next, which is the most appropriate response to the outstanding fees from the Milbury company? The auditor should resign from the client. No, that would be a heavy response. Don't be that much heavy. Auditor should report the client to the ACCA. Oh no, 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 no. The auditor can continue working of the client should ensure that the audit firm's credit control department are informed of the outstanding fees. No. Then auditor's report for this year should not be issued until the fees have been paid. Best option. Okay, move on. The audit firm should request the fees are paid. Audit firm must not issue this year's auditor's report until the fees have been paid. Uh, Which of the following statements, in respect of the relationship between the new financial controller and the audit firm, are true? The audit approach should be revised to ensure procedures and items to be tested are not predictable. The audit, and yeah, first option is itself is correct. As you know, the audit will need to be planned carefully to ensure that the work is not predictable, especially as the new financial controller is an ex-employee of the firm and will know the how the firm's procedures. The composition of the audit team should be considered, and anyone who has remained in the close contact with the new financial controller should be removed from the team to avoid a familiarity threat. It is very unlikely that a significant familiarity threat would arise from an audit senior joining the audit client. The significance of the threat increases with the seniority of the person, for example an audit partner. Therefore the audit firm would not need to resign. It is the audit firm's responsibility to manage an ethical threats and take appropriate action. They cannot stop someone from taking a job with another organization. Okay. Uh, which of the more Next question? Which of the most appropriate? Which is the most appropriate response from with the respect to the discount offered by the Milbury company to the audit team? Okay. Well, the discount may be accepted as it is the same as as that offered to the client's employee. No, the discount should be rejected as it is unlikely to be a trivial monetary amount. Trivial means amount which is lower than materiality level. Okay, so yeah, option two is in this case. As you know, a discount of 40% is unlikely to be a trivial sum, and therefore the most appropriate option is to reject the discount. The ACCA Code of Ethics and Conduct allows acceptance of goods and hospitality that are considered trivial and inconsequential. Approval should be sought from the audit engagement partner, not the audit manager. The last question from this scenario, okay, and that is select the option which correctly identifies whether or not a self-review threat is likely to arise in relation to the tax services required. Tax return, yes. Tax advice, yes, no. Tax return, no, no. Yes and no and yes. So D is the better answer in D. Last option is the correct answer. So far, so good. We are done with the 15 questions. Okay. Now, next one. The following scenario relates to question 16 to 20. Okay. And what they are saying, you are an audit manager in Tiger and Co, a large audit firm which specializes in the car manufacturing industry. Details of the three companies operating in this industry are given below. Vinico, Tiger and Company has audited Vinico for many years. The audit engagement partner for Vinny Company has been responsible for the audit for 6 years. Okay. The board of directors has asked if Tiger and Company will provide payroll and bookkeeping services, including providing advice on appropriate accounting policies. They have also suggested that external audit fee should be renegotiated with the at least 20% of being based on the company's profit after tax, as they feel that this will align the interest of Tiger and Co and Vinico. E-Core Company, Eor Company is a subsidiary of a major global car manufacturer. During the audit, team discovered that every E-Core co had developed and used a device which gave false regarding during government tests, which are required for all cars. The false regarding enable cars to meet the government restrictions on carbon emissions, which would otherwise have failed and therefore could not have been sold. The audit engagement partner has discussed the matter with the senior management of Europol and advised them to report the matter to this industry regulator. Senior management has refused and reminded the engagement partner that the audit firm has a duty of confidentiality towards the company. So far, so good. Uh, okay. So, Teagate Co. has recently approached Tiger and Co. to act as auditor due to the firm's exercise expertise in the car manufacturing industry. Teagate Co. is the main competitor of Wine Co. Which two of the following statements are true in respect of the conflict of interest between Vinico and Piglet Co? Okay. Uh, Tiger and Co. must decline the audit engagement of Piglet Co. No, sorry. Vinico and Piglet Co. may be concerned that commercially sensitive information may be disclosed by Tiger and Co. to their competitor. Yes, this is the right one. Then Tiger and Co. must ask permission of ACCA before accepting the audit of the Piglet company. Tiger and Co. must obtain consent of both clients before continuing with the engagement. Yes. So option two and option four are the correct one. The audit firm must obtain consent from both firms, both organizations. If consent is not given, the firm must decide which client to keep. The firm does not have to choose its current audit client. It could decide to resign from the audit of Vinico and accept the audit of Piglet Co. There is no requirement for an audit firm to consult with the SEC and request permission when a conflict of interest, such as the one described, arises. Okay. Next question. Which of the following is not an action that your firm should take to manage the uh, conflict of interest between Vinico and Pigletco? Okay. So monitoring of its safeguards by engagement quality reviewer? No. Require every employee of Tiger and Company to sign a confidentiality agreement. So option two is the best one and the correct one. Audit teams of each client would sign a confidentiality agreement, but it would not be necessary to have all employees of the firm sign confidentiality agreements. Okay, next question. Which of the following option statements is true in respect of the audit of Winnie Company? Uh, the audit engagement partner must be rotated. No, providing the additional services for Winnie Company will create a confidentiality threat. No, payroll and bookkeeping services cannot be provided to an external audit client. No, providing advice on accounting policies is acceptance as long as a client is responsible for choosing the specific policies used. Yes, this is the right one. Okay. In relation to the proposal that 20% of the audit fee is based on the profit after tax of the company, which of the following statements is correct or true? Okay. So I would suggest that, yeah, This will lead to fee dependency, which is a self-interest threat. The proposal should be rejected. No, this is a contingent fee arrangement which creates an advocacy threat. The proposal should only be accepted if no more than 15% of the audit fee is based on the profit before tax. No, this is a contingent fee arrangement which creates self-interest threat. The proposal should be rejected. So, yes, third option is the right one. As you know, uh, the upon contingent fee arrangement, such as the one described, creates a self-interest trap. The auditor should have a financial interest in the client achieving a higher profit and may ignore misstatements which would reduce profit if adjusted. The proposal must be rejected as the ACCA Code of Ethics and Conduct does not allow contingent fee arrangement for assurance work. Okay. Question number 20. Senior management is correct that reporting the company will constitute a breach of confidentiality. Yes, it falls. Okay. Tiger and company must report the breach of laws and regulations to appropriate authority if the client is refuses. It's true. Uh, Tiger and Co must report the breach of the laws and regulations as it is a public interest matter. Yes, true. Tiger and Company must report the matter to the parent company and the audit firm responsible for the parent company audit to. So, in accordance with either 250 revised considerations of laws and regulation in an audit of financial statements, the auditor has increased responsibility when a non-compliance by a client is identified. The auditor must try and get the client to report the matter themselves in the first instance. If the client refuses and the breach is likely to be in the public interest, the auditor must report the matter to the appropriate authority. So far, so good. I hope things are getting clear to you. The exam technique of doing these questions, that means questions of section A exam technique is also getting clear to you guys. So, by the way, let us move to the new scenario. Cameron Company has recently become a listed company. Cameron Company is required to comply with the corporate governance principles in order to maintain its listed status. The finance director, Lindsay Lewis, has undertaken a review of compliance with corporate governance regulations. The board composition, Cameron Company Board of Directors comprises of 6 members. Oya Osborne's chief executive and chair 5 years. Okay. Two roles at a time. Okay. Lindsay Lois, finance director 10 years. Hayden Hug, sales director 5 years. Karle Khan, human resource director 7 years. Jules Jardine, non-executive directors 10 years. Taylor Tahir, independence non-executive directors 3 years. So directors were last subject to re-election 3 years ago. Okay. Ola Obsurance has been the chief executive of Cameron for 5 years and recently been appointed as the board of chair as well. Ola Obsurance is considering appointing a close friend as a non-executive director. Taylor Thai is responsible for ensuring employee interests are represented in board discussions. So directors was last subject to re-election 3 years ago, and Ola Apsarans has been the CEO, chief executive of Chemical for 5 years, and is similarly appointed. Okay, Taylor size. Okay, directors remuneration. Executive directors are paid a fixed salary, which increases annually in line with the inflation. There is no performance related pay or bonus awarded to the executive directors as the company and does not want to provide incentive for financial results to be manipulated. The company does not have an audit committee as a board of directors, not considered it necessary due to the experience of Lindsay Lewis. They are aware that an audit committee is not required and have proposed that one is established, compromising the two non-executive directors, Lindsay Lewis and Ola Osborne. Select whether the following matters in respect of board composition represent a corporate governance strength or deficiency. So, Ola Obscurance is the chair and chief executive. Well, this is a deficiency. No doubt. One role should is designated person to assist with the workforce engagement. This is a strength. And then all of Obscuran is considering appointing a close friend as a non-executive executive director. It's a deficiency. Okay, the chair and the CEO role should be performed by different people to avoid too much power being held by one person. And additionally, the chair should be independent on appointment. And this is not the case with Ola Osborne, who has only recently been appointed chair and after being chief executive for 5 years. So the board should understand the views of the company's other key stakeholders, such as employees. The company should use a director appointed from the workforce, a workforce advisory panel, or designated non-executive director (NED). Taylor Tahir is a designated NED. Directors, both executives and non-executives, should be appointed based on merit, relevant skills, and experience. Okay. Uh, which of the following can be a member of the audit committee once established? Ola Osborne, Lindsay Lewis, Jules Jardine, or Taylor Tahir? Taylor Tahir. Uh, well, Taylor Tahir. How? See. Uh, The audit committee must comprise independent entities. This means Lindsay Lewis, executive director, Ola Osborne, executive director, and Jules Jardine, NED. Board not independent cannot be members. Additionally, the board chair cannot be a member of the audit committee, which is another reason for Ola Osborne cannot sit on the audit committee. Therefore, only the Taylor Tahir can be on the audit committee. Next question. Okay. Match the two issues given to the most appropriate response. Issue: the board is not balanced. Okay, an audit committee should be set up immediately. No, it's 10. For this issue, I would suggest, well, not A, establish specific criteria to assess candidates to ensure appointments are based on the merit and relevant skills and experience. No. Introduce share options to align the remuneration of executive directors with the long-term success of the company. No. Appoint three more independent non-executive directors. Yes, this is the appropriate response for this part. Then for the next part, issue, that is the executive directors are paid a fixed salary which increases annual salary in line with inflation. An audit committee should be set up. No, I mean, no, establishes specific criteria to assess candidates to ensure appointments are based on the merit and relevant skills and experience. No, introduce share options to align the remuneration of executive directors with the long-term success of the company. Well, yes, for issue two, I would suggest the answer is C. Okay. Why so? See, at least half the board, excluding the chair, should be independent non-executive directors. To balance the board of directors, three more non-executive directors need to be appointed. This will create a board of eight directors, excluding the chair, four of which will be independent non-executive directors. Three new plus Taylor Swift, Tahir, is it is unlikely that a company would reduce the number of directors to achieve a balance. So, executive directors' remuneration should include performance-related pay linked with the long-term sustainable success of company. That is, the share options. Now, next question. Uh, which of the following would not ensure Cameron Company is compliant with corporate governance principles? Okay, Julie's Jordan should replace Ola Osborne as chair. Yes. The chair must be independent on appointment. Julie's Jordan has been a member of the board for 10 years. Independence is deemed to be compromised if a director has served on the board for more than 9 years. So option 2, 3, and 4 are all provisions of the corporate governance codes. Now, the next option, the question, I mean, what is it? See, select whether the following statements in relation to the director's remuneration are true or false. The remuneration director should be set by the nomination committee. False. Workforce remuneration should be taken into consideration when setting the remuneration of executive directors. It is true. And the next one is the company should be able to withhold bonuses and share awards from directors whose performance is not acceptable. Yes, it is true. So the following scenarios relates to question 26 to 30. Saika Moore and Co. is the auditor of the Fair Company, a listed company operating in the computer software industry. The audit team comprises an engagement partner, a recently appointed audit manager, an audit senior, and a number of the audit assistants. So the audit engagement partner has only been appointed this year due to the rotation of the previous partner who had been involved in the audit for 7 years. Only the audit senior has experience of auditing a company in this specialized industry. The previous audit left the firm before the completion of the prior year audit and is now the finance director of Fair Company. The finance director and new audit manager are good friends. The board of Fair Company has asked if Saika Moore and Co. can take on some additional work. The following additional non-audit services have been requested. Okay. Routine maintenance of payroll records, assistance with the selection of a new executive, non-executive directors, tax services whereby Saika Moore and Co. would lies with the tax authority on Fair Company behalf. Saika Moore and Co. has identified that the current year fees to be received from Fair and Co. for audit and other services will represent 16% of the firm total fee income and totaled 15.5% in the prior year. The audit engagement partner has asked you to consider what can be done in relation to this self-interest threat. Okay. Uh, in relation to the composition of the current audit team, select which of the following fundamental principle is at risk and select an appropriate safeguard. Integrity, reinstate previous partner, no professional competence and due care, resign from the engagement, no confidentiality, assign a completely new audit team, no objectivity, provide industry training for the team members. Yes, last option, D option. I mean, two in this case, two and D, two and D, right? Is the right answer. Okay, the fundamental principle at risk is professional competence and due care. As many of the team are new and do not have relevant experience in relation to the specialized industry in which Fair Company operates, it is not appropriate to reinstate the previous partner as the previous partner has been rotated due to long association. A cooling off period must be served before being involved with the client again. The audit firm should offer appropriate training for the audit team to ensure they have the necessary knowledge to carry out the work. Then we have next question. Select the type of threat which could arise as a result of the finance director's relationship with the audit manager and select an appropriate safeguard. Uh, Self-review threat, no. Familiarity threat, yes, it is. And the finance director must not have contacted with the audit manager while the audit is going ongoing. No, the firm should resign. No, the different audit manager should be appointed. Yes, this is the right answer. As the previous audit manager is now the finance director at the client, there is a familiarity threat due to an ongoing relationship between the old and new audit manager. So the familiarity threat is not so served that the firm would need to resign. It is not practical to prevent the audit manager speaking to the finance director during an audit, as this will reduce the efficiency and effectiveness of the audit. So, new audit managers should be appointed. Okay, next question. Ignoring the potential effect on the total fees level, identify the threats to independence from providing the non-audit services. Uh, Routine maintenance of payroll records. It is a self-review. Assistance with the selection of a non-executive director. It is a self-interest. And the last one is tax services, whereby Saika Moon and Co. would lies with the tax authority on fair company behalf. It is an advocacy threat. So, as per ACC Code of Ethics and Conduct, the following threats would be created from carrying out the non-audit services required by fair company. First, for payroll self-review, as auditor will also be involved in auditing the figures included in the financial statements in relation to the wages and salaries. for recruitment, self-interest as the auditor would be involved in selecting an officer of the company who has significant influence over the financial statements and audit. And finally, the tax, that is advocacy, as the audit may be perceived to be representing and promoting fair companies' interests in liaising with the tax authority. Uh, Next question. Which of the following safeguards would not be relevant in mitigating the threat, identifying in relation to fees? Okay. Disclosure to those charged with governance that fees uh, from fair company represent more than a 15% of Sycamore and Co's total fee income? No. Pre-issuance review to be conducted by an external accountant? No. The use of the separate teams to provide the audit and non-audit services. Option three is the right answer. Using separate teams will not address the self-interest threat from the fee levels, as separating the teams will not alleviate the firm's potential financial dependence of on FIR company. Last question of this scenario. Okay. During the audit of fair company, a suspicious cash transfer has been identified. The audit team has reported this to the relevant firm representative as a potential money laundering transaction. Which of the following statements is true regarding the confidentiality of this information? Okay. Uh, Details of the transaction can only be disclosed with the permission of FIR company. If there is a legal requirement to report money laundering, this overrides the principle of confidentiality. Yes. If Alan Marshall accepts the position as a non-executive director